Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn and Kansas City wheat. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of these patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Chicago wheat. 3 weeks ago I drew a steep bullish Andrews pitchfork for the recent moves, which was finessed last week into a bright red mid-April to early May bullish shift pitchfork. Now, last week I noted that we were moving down towards the bright red lower tone, which is currently 633 1/4. And as I said last week, and I quote, we may well be on the way to retiring this bright red pitchfork as well. If we do, then I'll be on the lookout for what next could be the main pattern here. End of quote. Well, we actually closed last Friday just below the bright red lower tone, as well as the green short medium moving average, which is currently at 624 even. But we're held up by the 50% Fibonacci line of the May 24 to May 25 move at 622 1/4. However, that support only really lasted a couple of days and prices motored on lower. And as a result, I'll retire the bright red shift pitchfork after this commentary. Prices continue to push low and have dipped back below the significant, if broken, May/July 2023 to date upper bear channel line, currently at 602 1/2, highlighted in purple on my daily chart. Now, I'm watching this move lower carefully, as I have not as yet ascertained if this is a repair or if this purple upper bear channel line is no longer important. Nevertheless, and separately, prices have now started to halt in their decline, prompted by the combination of the congestion between 594 3/4 down to 588 even, as well as the slowly rising mauve medium moving average. Now, I've previously also spoken about how the whole January to date action could be one leg of a possible bullish halfway hesitation. I had thought this to be a valid case, but last week as the prices headed lower I started to have some doubts. Thus, with the market already reaching the primary target up in the 652 area, I will retire after this commentary the secondary hardest reach target X1, which is up in the 701 area. This had looked good as a pattern idea as long as prices stayed above the upper bear channel line, but now, not so much. This brings me to my final point, and it relates to what I said earlier about this market developing a new pattern. And I think it has done so. I think we have a mid-April to date, somewhat lopsided double top pattern, an Adam and Eve type. We've broken down through the key 605 1/4 level, so I will lay some potentials below. Not targets yet, but potentials, as we haven't fully stabilized below this 605 level. Thus, a primary potential will be down in the 561 1/2 zone, just under the long moving average, currently at 564 3/4, and a secondary harder to reach potential will be down in the 518 3/4 zone, just under the 38.2% absolute Fibonacci line at 521 even. It all now depends if prices can keep the momentum going lower, especially under the 588 to 594 3/4 congestion. Chicago corn. The key pattern here was, until this week, the August 25 to January 26 dark blue bullish shift pitchfork, a fantastic showrunner. The break low was created by a new bearish pattern formed since mid-April, which I warned about last week. Mid-April to late May double top, a bright red neckline, currently at 465 1/2. We were not fully stabilized under this pattern last week, but as I said last week, and I quote, the depth of the move lower has prompted me today to start laying out some potential targets. Only potential targets right now, but potential targets below for this possible double top. Thus, we have a primary potential target down in the 454 even zone, a target which we have already reached, just about, and a secondary hardest reach potential target X down in the 440 1/4 zone, close to the November 2020 high at 439 1/2. End of quote. This week on Wednesday, we reached this harder to achieve secondary target. Yet that was not all, as I continued last week when I said, and I quote, But perhaps most interestingly, under the now rising gold long moving average, which is currently 447 3/4, I should also note that we managed to get below the 450 level, that if we managed to get below the 450 level, then we could also trigger another bigger bearish pattern, a March to date larger double top pattern. So please watch this space carefully. End of quote. Well, we are well below the 450 level, down testing the 50% absolute Fibonacci line at 425, which is a story on its own. But importantly, we now have a March to start of June larger even eve double top, with a primary target down in the 432 1/4 zone, the target we achieved yesterday, and a secondary hardest to reach target X1 down in the 410 3/4 zone. I'll be very interested to see if prices can make it down to the secondary hardest to reach target, especially in the immediate future if prices can establish themselves below the 50% absolute Fibonacci line, which I think may be hard, especially given the action we saw when prices were last down here back in early January. Kansas City wheat. I said 5 weeks ago, and I quote, much like Chicago wheat and also something I've seen in the oil seeds and vegetables yesterday, it brings to mind whether the whole January to date action, in this case I look at the whole mid-December 25 to date action, as one leg of a possible bullish halfway hesitation. I think this is a valid case here, right now at least, so I'll put forward the following targets topside for such a pattern. Therefore, a primary target will be up in the 686 3/4 area, a level we have already reached, with a secondary harder to reach target X up in the 745.5 area. This looks good as a pattern idea, as long as prices can stay above at least the lower bull channel line of the doubled up bull channel, and ideally above the whole tripled up bull channel line itself. End of quote. Early 3 weeks ago, prices finally reached target X, the secondary harder to reach target, and have pulled back down ever since, breaking down through the significant supports and creating a new, smaller, more recent pattern. 2 weeks ago I said, and I quote, I suspect we may have a very short dated, made over the last 2 weeks or so, ever since the gap in early May, gap up in early in May, a possible descending triangle in formation. So far we have not broken out of it, but just in case, as it might run out at the middle of next week, so the week that's just gone past, I'd like to lay out some possibilities, not targets, just possibilities. Thus, for a break higher over the upper trend line, would have a primary possibility of a move up of 37 3/4 cents, with a secondary harder to possibility of plus 59 cents. Whilst a break, this is the important bit, whilst a break below the small gap would have a primary possibility of minus 29.5 cents, and a secondary harder to achieve possibility of minus 59 cents. I'll be interested to see how this pattern idea develops. End of quote. Last week, these possibilities on the downside for the descending triangle became a primary target at 661 3/4, a target which we almost reached last week, and which only had the green short medium moving average, currently at 662 1/4 protecting it, and a secondary hard to reach target X1 down at 632 1/4. Late last week, the primary target was reached, and this week indeed, yesterday, prices reached the harder to achieve secondary target X1 and have started to slow ahead of the rising mauve medium moving average, currently 621.5. This move lower, much as in Chicago wheat, has opened up the idea for a possible mid-April to date double top pattern, though I have to admit is one very, very lopsided double top. Nevertheless, it seems I can lay out some potentials below of a primary potential down in the 627 zone, which with today's low at 627.5 has just about been reached. Have we been down to? No, we actually went through that, so we're down at 625, so it has been reached. And a secondary harder to reach potential down in the 578 zone, right on the July 21 low. Right now, the secondary harder to reach target looks just that, harder to reach. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Toffpick and ADM Investor Services International Limited. And here comes the final important bit.